Something just happened in the $30 trillion American bond market that we haven't seen since October 1929. And if history repeats, the next 6 months could be brutal. And I will explain how this can have a devastating effect on the stock market. Bonds are supposed to be the bedrock, but sadly the foundation is cracking in ways we haven't seen since the autumn of 1929, just weeks before the world changed forever. Let's get into it. The bond market is a living and breathing dragon with about $30 trillion of supposedly safe, boring debt that nobody pays attention to until it's too late. Because here's what matters most and what people don't understand. When bonds break, everything breaks. Stocks, real estate, pensions, savings, jobs, everything. And the bond market just sent a signal that has only appeared a handful of times in the last century. And every single time it appeared, what followed was a great devastation. The following story is an important puzzle to understand, so listen carefully. In October 1929, a man named Jesse Livermore sat in his office on Wall Street watching something strange happen. He was one of the greatest traders who ever lived, a man who could read markets like others read books. What he saw in the bond market that autumn made his blood run cold. Treasury bonds, the safest investment in America, were acting erratically. Yields were spiking. Liquidity was vanishing. Big institutional players were dumping their positions quietly, desperately trying to raise cash. It was subtle. Most people missed it entirely, but Livermore understood what it meant. He saw the foundation was giving away. 3 weeks later, the stock market collapsed. Not a correction, not a dip, but a complete and total annihilation. The Dow Jones fell nearly 90% over the next 3 years. 9,000 banks failed. Unemployment hit 25%. And it all started with a whisper in the bond market that nobody wanted to hear. Now fast forward to today, that same whisper seems to be back, and it's getting louder. Most people think bonds are boring. They are safe and predictable, and it's the place where old people and pension funds park their money to collect a steady return. But that's exactly why bonds are so dangerous when they break, because everyone assumes that they can't. Stocks are supposed to be volatile. Real estate goes up and down. But bonds? No. The bonds are the bedrock. They are what every other asset is priced against. When you hear about mortgage rates or corporate borrowing costs or credit card interest, all of that flows from the bond market. It's the sun around which everything else orbits. And right now that sun is behaving in ways it hasn't started since 1929. Here's what's happening. For the first time in nearly a century, the bond market is experiencing what traders call a loss of confidence event. That's Wall Street talk for people that are panicking quietly. Foreign governments that have held US Treasury bonds for decades are selling them at a pace we've never seen before. China has dumped over $1 trillion in US debt in the last few years. Japan, now facing its own crisis, is liquidating positions to defend its currency. Even the Federal Reserve, which used to buy bonds to support the market, is now letting them roll off its balance sheet. Trillions of dollars of buying power have just vanished. So who's left holding the bag? Banks, pension funds, and insurance companies. Your retirement account. All of them were stuffed full of bonds that were supposed to be safe. But here's the problem. When bond prices fall, which they do when nobody wants to buy them, the entire system starts to wobble. Let me explain this with another story. In 2008, a small hedge fund called Bear Stearns collapsed almost overnight. Most people think it was because of bad mortgage bets, and that's partially true. But the real killer was what happened to their bond portfolio. Bear Stearns held billions in supposedly safe assets, including treasury bonds. But when panic hit and they weren't needed to sell those bonds to raise cash, they discovered something terrifying. There were no buyers. The market had frozen. Liquidity had evaporated. And when they finally did find buyers, they had to sell at massive losses. Within 72 hours, an 85-year-old institution was simply gone, wiped out. And not because of recklessness, but because the safest market in the world stopped functioning. That same liquidity crisis is building again right now. And this time, it's way bigger. The bond market today is more leveraged than at any other point in history. Banks and hedge funds don't just own bonds, they borrow money to buy more bonds, magnifying their returns. It's called the basis trade, and there's an estimated $4 trillion locked into it. It works beautifully when markets are calm, but when volatility spikes and prices of bonds start falling, those leverage positions turn into anchors dragging everyone underwater. Margin calls start, and then forced selling begins, and then suddenly the safest market in the world becomes a death spiral. Here's where it truly gets unsettling. In 1929, the bond market seizure happened because of the gold standard constraints and bank runs. In 2008, it happened because of mortgage-backed securities and over-leverage. But today, we're facing something unprecedented. We have record government debt, nearly $36 trillion and climbing. We have the highest interest rates in over 2 decades. We have foreign holders abandoning US debt. We have the Federal Reserve stepping back instead of stepping in. And we have the entire generation of investors who have never seen a real bond crisis and have no idea what's coming. When this unravels, and history suggests it will, the cascade will be swift and merciless. It starts with a few cracks. Maybe a regional bank fails because its bond portfolio is underwater. Maybe a pension fund announces it can't meet its obligations. Maybe a treasury auction fails to attract enough buyers and yields spike volatility. Whatever the trigger, what follows is always the same. Selling begets more selling. Panic feeds on itself. And suddenly everyone realizes at once that the emperor has no clothes. Remember 1994? The bond market crashed that year, and most people don't even know it happened. Orange County, California, went bankrupt. Dozens of hedge funds collapsed. The ripple effects hit Mexico, and they triggered a currency crisis. All because bond traders misjudged the Fed's intentions and got caught on the wrong side of a yield surge. That was a small tremor compared on what's building now. A quick reminder to subscribe if you found anything valuable so far. Now back to it. Or think about 2022. The UK bond market, called gilts, nearly imploded in a matter of days. Pension funds across Britain faced total collapse. The Bank of England had to step in with emergency intervention to prevent a systemic meltdown. That's a preview of what happens when confidence breaks in a major bond market. And the UK's bond market is tiny compared to ours. The most terrifying part is how fast it happens. Stocks can crash slowly. Real estate declines over months or years. But bond markets, when they break instantly. Because bonds are supposed to be safe. They're supposed to be liquid. When that assumption shatters, there's no gradual adjustment. There's just panic. In 1929, the treasury market froze in a matter of days. In 2008, entire classes of bonds became untradeable overnight. Speed is the killer. So what does this mean for you? It means the next crisis won't start with stocks falling or housing prices dropping. It'll start with a spike in bond yields, a seizure in treasury markets, and a bank announcing massive losses on its bond holdings. And by the time the news reaches Main Street, the damage will already be done. Your 401k, which you thought was safely invested in the bond funds, down 30, 40, maybe 50%. And your pension, underfunded and unable to pay. Your savings account on top of that earns nothing while inflation devours it. The warning signs are everywhere if you know where to look. Treasury auctions are struggling to find buyers, and the spread between short-term and long-term bonds has behaved erratically. Foreign central banks are net sellers for the first time in decades, and volatility in the bond market, measured by the MOVE index, has spiked to levels only seen during major crises. History doesn't repeat, but it rhymes, and right now the bond market is reciting the same dark poem it whispered in 1929, a poem about confidence lost, leverage unwound, and foundations crumbling. Jesse Livermore saw it. The few who paid attention in 2008 saw it. And if you're paying attention now, you can see it too. So the question is, what are you going to do about it? You have to prepare. You diversify away from overexposure to bonds and you hold cash. Also avoid excessive debt and recognize that when the $30 trillion bond market sneezes, the entire global economy catches pneumonia. Remember that the safest investments are only safe until everyone realizes that they're not. The bond market just did something not seen since October 1929, and everyone who ignored that signal back then had paid a price that lasted a generation. So don't be the person who learns this lesson too late.